The following program is being brought to you on the Voice America Business Channel. For more information about our network and to check our additional show hosts and topics of interest, please visit voiceamericabusiness.com. The Voice America Talk Radio Network is the worldwide leader in live Internet talk radio. Visit voiceamerica.com. The views and ideas expressed on the following program are strictly those of the host or guests and do not necessarily reflect the views and ideas held by the Voice America Talk Radio Network, its staff, and management.
The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Whites, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hey, good morning, everybody. It's Tuesday, January 28th, 2014. Welcome to the In Black and Whites radio show. It's a new program here on Voice America Business, and I think you're going to like the next 13 weeks. It's all about you, your investing, and your financial future. So I appreciate you listening in. I'm going to give you a couple thoughts about what the show is going to be about, and then we're going to get right to the program. First, I want to start out and give you a couple of housekeeping notes. Number one, you can reach us on our blog at inblackandwhites.com. You can follow me on Twitter at Peter Weitz, that's PeterWeitz.com. You can download the Voice America Business iPhone, Android, and BlackBerry app, and you can listen to your show via your cell phone. You can follow me on LinkedIn at peter.weitz, and you can join us on Facebook at In Black and Whites. Facebook's going to be an interesting one. You know, when I put the show together a couple weeks ago, they put together a photograph of myself in a very pensive look with my hand over my chin, and it's turned out that a bunch of my partners in my company have determined that they think it's funny, and they've now deemed it to be Weitzing. So feel free to mail in your photograph to our website at In Black and Whites, or you can email it to me at peter@inblackandwhites, of you with your pensive look, and I'll be happy to post it on our Facebook page. And make sure you use the hashtag Weitzing. We'll see if we can get this trending. So with that, again, I welcome you to the show. I want to thank our sponsor for today, Stephen Douglas and Associates. But before I begin, I want to tell you a little bit about myself and what it is I do. I'm a financial advisor by profession. But what does that mean? Does that mean I just sell stocks and bonds? Well, actually, no, that's not what it means. What it means is this, and I came up with this several months ago when I was watching the movie The Blind Side. I don't know if you remember in the very beginning of the movie, there's a monologue that Sandra Bullock delivers about a football game in which Joe Theismann of the Washington Redskins was a quarterback, and he was playing the New York Giants. And on this one particular play, Joe Theismann leans back to pass. And he's a right-handed quarterback, so when he comes back to pass, he turns to his right, which then makes his back face the left side of the field. Well, at that time, Lawrence Taylor was the best dominating linebacker in the league. He was blitzing up the left side. And because Washington did not have a strong left tackle, Lawrence Taylor was able to penetrate through the offensive line and tackle Joe Theismann in such a ferocious way that it broke his leg, and he ended up never playing football again. Well, the interesting thing about that is that when I look at what we do as financial people, what we do as investors and as research, and you'll hear more about our research as we get into the show today, I feel it's important to understand that without a good financial left tackle, you can't be protected from the things that you can't see. So when you think about investing, think about the risks that you're not aware of, that you don't know about because you're not trained to do so. We are, and that's what we think about. So when you think about me as a financial left tackle. Remember the movie The Blind Side, and you'll understand what professionals in the financial industry do. So with that, let me get on to today's topic at hand. Today we're going to talk about the top 10 investment themes for 2014. And I want to bring in a quick story so that you get an idea of what we're talking about. Remember when you were growing up, you played a game called Go Fish, and your partner would say to you, do you have any sevens? And you would say no, and then you'd follow it up by saying go fish. Well, go fish is kind of what we think is really the theme for this year's marketplace for making money. There's opportunities to make money out there in investing. You're just going to have to go fishing to find them. So even though we think that there's some high uncertainty, our investors' goals have not changed. They all want to make money. So how are you going to do that? Well, let's talk about with what you can expect in 2014 and for the new year. For starters, it's going to be a lot of the same from last year. There's going to be slow, measured growth, particularly in the U.S. economy. Interest rates are going to remain incredibly low, and there's going to be really low inflation. And while these conditions are not necessarily ideal, we do believe that the stock market will continue to grow domestically if you know where to fish to find it. We also feel globally the stock market's going to grow, particularly in Europe, as they continue to recover from what was their depression. Let's talk real quickly about risks. There's interest rate risks. Obviously, with interest rates so low, a rise in interest rates at any point during the year could really crush a blow to the bond market, and we'll talk about that today. The stock market last year rose over 29% in the S&P. That lends credibility and credence into maybe diversifying into companies outside the U.S., as there may be other growth there, and maybe some of that growth has stalled here in the U.S. And finally, there's political risk. While I don't consider this show to be a political show, investors need to be cautious of what what Congress is doing in Washington. It's completely dysfunctional there, and I can say that because I lived there for 17 years. So before I get into our guests, the question begs for you, the investor, for you, the listener, where does this leave you? What do you do to incorporate interest rate, politics, and growth into your investment matrix? Well, for starters, let's talk about the typical investor. Lately, we seem to be coming across many of you who have, quote, money on the sidelines. It's doing nothing for you, folks. You have to stay invested in order to make money. The mattress doesn't work. Okay. Interest rates are virtually zero. A 5-year CD barely pays 1%. That's a risk in and of itself. If inflation outpaces what you're earning in interest, you're losing money on cash. So for all intents and purposes, cash could be a bad investment as well. So just remember this before I get into today's guest. Nothing in life is free. Make sure you consult your advisor to make you aware of all the risks in the marketplace, and take steps you need to take to set your goals for the future. So a la Letterman-esque, and from the home office here in Coral Springs, Florida, where the weather's beautiful, by the way, unlike my parents hard at work up in Springfield, Massachusetts at Denner Pellegrino, where it's a balmy 20, and Kevin will probably tell you in Boston that it's even less. Here are the top 10 investment themes for 2014. And again, I appreciate all the listeners. I know I've got at least one listener all the way out in Hong Kong, Michael, listening in on the show, even though they're 13 hours ahead. But without further ado, let me introduce our first two guests. I've got Kevin Lane, who's the managing partner at Fusion Analytics. And throughout his 20-year career, he's opined on a wide variety of financial matters, including broad market commentary, econometric and macro events, earnings and technical analysis. He's a sought-after analyst, having appeared on such great channels as Bloomberg, Fox Business News, CNBC, Barron's. He's also a partner at Fusion Analytics Investment Partners with me, a wealth management firm, and he's the founder of Fusion IQ, which is a quantitative web-based financial software research product. Several years ago, Business Week magazine, in their expose entitled Analysts That Get It, rated Kevin as one of the best stock pickers under the age of 40 in the United States. He's going to be followed by Don Burgess, who's a certified financial advisor, and his investment and analytical credentials were built upon a foundation of extensive C-suite corporate careers, primarily with Fortune 500 companies. His corporate position experience includes Chief Marketing Officer, CFO, Vice President of Sales and Marketing, and before joining Fusion in 2013, he provided portfolio management and investment consulting services for over 10 years. So with that in mind, I've got two very, very astute research and financial experts on the show today. I encourage you to call in. The listener line is 1-866-472-5795, 1-866-472-5795. I will also take your emails at peter@inblackandwhites.com. And with that, I'm going to kick off the top 10 investment themes for 2014. But Kevin and Don, good morning to both of you.
Good morning. Thanks, Peter.
And I want to point out that I don't typically guarantee, and our regulators don't like when we use the word guarantee with investing, but I am going to make a guarantee with it today being the 28th of January, and there's a big event happening on Sunday in New Jersey, and so I want to make a guarantee that you can all take to the bank, something that will absolutely happen in 2014, and that is this. If you go to the Super Bowl, you are going to freeze your ass off. Kevin, what do you think about that?
I think that's pretty accurate, and I think the NFL probably made a bad decision in terms of moving the Super Bowl from warm climates to cold climates. In fact, as we were talking off air, you were tracking StubHub ticket prices, which continue to fall. So I think that's probably a bad idea, but I would assume your guarantee is correct there.
Thank you. All right, so here it is. Guys, let's get into the serious stuff. So economy, we think the economy is going to grow this year. However, GDP is probably going to be in the low 3% range, and that's our investment theme number one, is that we're going to have growth, but it's going to be very slow. Kevin, what are your comments about slow economy and slow growth for 2014?
Well, I mean, if you look at, what's happened since the financial crisis, this is probably this is the slowest post-recession recovery that we've seen really since 1929, the Great Depression. So, joblessness, things of that nature, the jobs rates, while those are improving, they're improving at a much less robust pace than in past recoveries. There's clearly a lot of stimulus to try to get the economy back on track. But if you look at, there's two differences here. There's the economy and there's the stock market. Now, the stock market has responded very well to stimulus. The S&P from its trough in 2009 to its recent peak is up 177%, but yet the real economy hasn't done as well as financial asset inflation. So housing has recovered, the economy, the stock market has recovered. But if you look at the pace of job recovery and things of that nature, the real underlying economy has recovered much slower, albeit the track has been up and gradually recovering, but at a much slower pace. So I think you will start to see better growth this year in 2014 than you did in 2013, and 2013 was probably better than 2012. And each year as you move past the financial crisis, I think the underlying economy should improve, but I think investors should expect subpar GDP growth still in this cycle versus past cycles.
Don, any comments on that?
I'm also positive on an acceleration, a little bit of an acceleration in growth rate into the 3%, because I think there are three big trends underlying the economy that are giving support and will continue to do so, and one of them is the housing recovery. And I think the issue is we sometimes forget how far we fell. Last year, after which we were describing as a recovery in housing, we started 920,000 homes. If you asked, aside from the post-2008 crisis years, that is the lowest since, I don't know, because the government data only goes back to 1959. It was never that low prior to 2008. And by the way, in 59, it was 1.5 million. Second, we have an energy boom, which is going to continue to provide growth. We've been damaged by oil and oil prices for 40 years. And with the new technologies, the forecast can't keep up with the growth of production. Every time the production number comes out there, they have to raise the forecast. And as you replace imported oil with oil produced here, it's growth. And the energy boom and lower costs, particularly on natural gas, is supporting the third area, and that's a renaissance in manufacturing. From 2000 on, we moved everything we could to China to save money, and then we found out how much that's damaged the economy. Well, that's all coming to an end because the costs in China are rising year in and year out, and we're starting to see a trickle of factories coming back and production coming back to the U.S. But the other thing is with lower energy prices, particularly natural gas, we're seeing manufacturing that depends on that as a large part of their cost structure locating here. There's something like 100 chemical plants being built or in the planning phase that are going to be built in before 2020 in the U.S. And if you go down to Texas, Louisiana, they're lined up like dominoes from Houston all the way over. So,
and we're gonna talk heavily, Don, about energy as we get later in the show. I do need to take a quick break, but I do want to tell everybody coming back from the break, we're going to get deeper into the remaining 9 themes for the year, including energy, and Don's going to talk more about that. You're listening to Peter Weitz and the In Black and Whites radio show.
When it comes to business, you'll find the experts here. Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Whites is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hey, everybody. Welcome back to the show. I'm Peter Weitz. You're listening to In Black and Whites on the Voice America Business Radio Network. We're joined live today in the studio by Kevin Lane and Don Burgess, 2 investment and research experts. And we were talking about the top 10 business themes for 2014. We left off with an interesting conversation about energy, and we're going to get into that in depth later on in the show. But before we do, let me go through some more of the themes that we're talking about. Theme number 2 is fixed income. Continued rising interest rates, and maybe interest rates in the 3 to 3.5% on the 10-year. Don, you want to start talking about what we think about interest rates and fixed income?
Yeah, to me, the point is that we have a residual problem from the financial crisis, and that is the debt is larger than our economy. And it's at 106% or so to debt to GDP. The feeling is that's not sustainable. That has to be dealt with. So how do you deal with it? Are we going to raise taxes? I don't think so. Are we going to cut spending? It doesn't look like it. So what we're going to do is repress interest rates for a long time. And the last time this happened was post-World War II, and rates rose slowly for about 20 years. During that time, the bond market actually was up 15 out of the 20, And so our feeling is don't go 0% in bonds, but invest in the bond areas, the sectors that perform best in the moderately rising interest rate environments, and there are sectors like that.
Kevin, any comments on that?
Well, I think the first thing you want to look at, if you want to look at like a long-term perspective, on interest rates, everything in this world, the old, just like in fashion, history repeats itself and styles come back in vogue. From 1970, to 1981, the 10-year interest, and we can look at the longer dated bond like the 30-year, but looking at the 10-year, you rose from 6% up to about 16%. And then from 1982 to present, you've been in a secular bear market in terms of interest rates. Interest rates went from 16% on the 10-year, down as low as about 1.4%. And now you're sort of moving back up a bit here on the 10-year, close to 3%. But I think it's sort of twofold. Obviously, as Don touched on, there's a repression of interest rates to try to make the debt more serviceable. But I think over time, after 20 some odd plus years of falling interest rates, eventually, whether it be stimulus and ultimately global economic growth starts to recover in a more aggressive way, then you'll get a backup in rates. But because the recovery is so tenuous at this point, I don't think there's no pressure in labor markets. There's no wage pressure yet. There's still not full employment. So I think interest rates, while they may gradually move up, will probably be range bound, maybe on the 10-year between 3.5%, maybe down to 2.5%. But as far as looking at a real surge in interest rates anytime soon, I don't think that's likely.
Thanks. I was thinking, too, as we talked in the beginning of the show about the Super Bowl, and I was thinking we talked a little bit about the economy. I read an interesting statistic the other day, and Kevin, I'm really interested in your opinion on this because I just don't get it, okay? The statistic I saw, it said that Americans will consume 1.25 billion chicken wings on Super Bowl Sunday. That's 1.25 billion chicken wings. So by my math, and again, you guys are the experts in math, I'm not, that's 650 million chickens. I'd like to know where all these chickens are.
Well, if that's the case, then, maybe the idea, and we would have to, dig into our research archives and look at the historical correlation there, but there could be a short-term trading opportunity then in Tyson Foods ahead of the Super Bowl. But we'd have to go and look at the historical data and see if, buying Tyson Foods the week or two before, the Super Bowl and holding that stock through the game resulted in a profitable trading opportunity, on a high percentage basis, but we don't have that data available. But that's the way to play it, evidently.
I am going to hold you to that. We are going to follow up on a later show, and I want to get your response with regards to what Tyson Food does during the chicken wing season of the Super Bowl. But with that in mind, what's your comments on theme number 3, the U.S. stock market?
Well, let's start at the beginning first, I guess. The stock market's a very complex place. What people perceive to be happening versus what happens. Sometimes it's almost reverse, if you will, meaning, at the precipice of the 2009 lows, when everything looked its worst, obviously was the best opportunity to buy. And, for most people, that's a perverse mentality. Well, if things are so awful, why would I want to buy? And, of course, when things look their best, towards the 07 peak or even, the prior peaks in 2000, it's you think, okay, things are great. I should be buying. Everything's wonderful. GDP growth is strong. Equity markets are doing well. I should buy. But the reality is it turns out to work retrospectively and inverse almost, that by the time things get so bad, people have discounted the worst. And in the 09 low cases, people were discounting pretty much Armageddon, another Great Depression. So equity valuations and things way overshot where they should be. But at that point, a lot of the selling had already been done. Basically, the selling was exhausted. People had so much thrown in the towel that when you reach that low, there was really nobody left to sell. Anybody that wanted to get out of the way or was stuffing money under the mattress did, and it turned out that was the best buying opportunity. Well, here we are now 177% higher than that low. Now, that doesn't mean the outlook going forward is not good, but certainly when you come back 177% off the lows of 2009, a lot of the easy money has been made between now and then. You're going to need other things to allow valuations and GDP and things like that to grow to continue to justify higher valuations. And, one of the points, on your topic list, was that valuations aren't necessarily overly high on the market, but they're not necessarily overly low either. And, there are these things, every once in a while, we call corrections that come into place. And the market since the 09 low, outside of 2011, the summer of 2011, where we had a pretty good correction of, about 14-15% trough to peak, the market has generally had very shallow corrections. The trend has been up. And, at some point, there's going to be a correction that's going to be quite painful. Now, it may be a correction in an ongoing secular bull market, which we believe, but let's just assume hypothetically you were to buy today as a new investor bringing new cash to the marketplace and you hadn't participated in this rally. If you walk in and put your money in and then you immediately, run into a 15% correction, that's not going to feel too good, even though the overall secular picture of higher markets could still be in play. So I think there's some risk of a possible correction or at minimum some sort of consolidation or trading range because the market has come a long way from the 09 lows. And so I think there's a risk of, putting your money in, in front of maybe a correction here.
Thanks. Real quick, Don, one of our themes is on Europe, and we've got a couple minutes before the break, so I just want to get your opinions on theme number 4, which is Europe.
Well, the narrative has shifted from 100% bad news, every headline bad, to improving in most areas. It's in many areas. It's still uneven. Everything isn't great. The UK seems to be leading. Other areas, Southern Europe, are still very weak. But we feel there are select areas that will perform best coming out of this recession that are opportunities.
Well, and Don, let me interrupt you. We think that Europe lags behind the U.S. in terms of recovery in the Depression, and that they're sort of at the bottom of the barrel right now. So do you feel that that's going to cause some great opportunity for investments in Europe at the moment?
Yeah. In one area is in smaller companies, which typically offer the best returns coming out of recession. That's something that we've been participating in.
Peter, so let me just jump in here for a second. So, again, there's also, where we've been and where we are. So as we're saying, Europe is recovering. There's that dislocation. Hypothetically, had you been an investor and you bought into, let's say, the DAX, which we always use as the benchmark for Europe because, Germany is probably the most stable economy, in the Eurozone. And that's up 97% just since 2011. So, again, while investors, particularly shrewd investors, don't wait for the economy to recover. They always use the term, the market is a discounting mechanism. People, smart investors, astute investors try to look forward. And a lot of people came to that same conclusion, like the U.S., okay, with the stimulus, with the backing of central banks, what have you, and this global sort of push to, get economies going, a lot of people invested when Europe looked its worst. So now you're up 97% on the DAX. I'm not saying that, Europe can't, do better in terms of the stock market, but a lot of that's been discounted into where we are now. And I think the key thing in Europe is for a while they tried the austerity measures and they found, okay, well, that hampered growth. And for Europe to come out of this, and certainly they're starting to come to that conclusion now, you have to stimulate more, you have to spend more. You don't, cut off the spigot until you're on more stable footing. So I think the fact that they're repealing some of the austerity measures in Europe and continuing on sort of a stimulus trajectory will help Europe come along.
And I appreciate that comment. With that, we're going to take a short break, pay some bills, You're listening to In Black and Whites on the Voice America Business Network.
From the boardroom to you, Voice America Business Network.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Whites. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter at inblackandwhites.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Hey, thanks everyone. Welcome back. Peter Weitz. This is the In Black and Whites radio show. I'm joined today by market expert Kevin Lane and analyst Don Burgess. We're going over the top 10 investment themes for 2014. And we're going to spend a little bit of time on 2 that I think are going to be pretty important to the listening community out there. So I'm going to rip through a couple of these others real quick, if that's okay with you, Kevin and Don.
Sure.
First, I want to talk real quickly about municipal bonds. It's been an interesting place in that we've had a lot of scared people with what's going on in Detroit and what's going on in Puerto Rico. Well, the reality of it is that tax-free returns are still healthy, and beauty's in the eye of the beholder. There are some great bonds that are out there. You just again, it's following this Go Fish theme. You have to go look for them. Pricing of the municipal bonds are irrelevant if you're holding them just for the income, because if you hold it to maturity and it matures at par, you don't care what happens in and out of the pricing structure along the way. So we actually like municipal bonds as a sector going forward in 2014. We also like commercial construction, and it's a very specific sector. It has not yet participated in the recovery. What we've seen first is absorption in the commercial sector of existing real estate and not necessarily new shovels in the ground building new product. That's just starting to hit now. So when you think about commercial construction, you look at steel manufacturers, cement companies, trucking. So companies that the big names, like you saw Caterpillar's earnings yesterday. So Caterpillar, John Deere, U.S. Steel, big, large companies that are going to help in the construction sector. I think is going to be a nice place for us to find some value this year. Healthcare. There's been a lot of talk about healthcare, particularly in what's gone on with Obamacare. And what's interestingly to us is healthcare was a phenomenal sector last year in terms of returns. We believe it's going to continue this year as Obamacare really affects the physicians more than it affects big pharma. So when the drug companies and the biotech companies continue to manufacture blockbuster drugs, we're still going to use them. People are taking more drugs, prescription drugs today. I'm going to actually clarify that and say prescription drugs. People are taking more prescription drugs today than they ever have in the past. And so we don't feel that that's going to change. And we think the healthcare sector is going to remain significantly strong. The last three I'm going to talk about, though, I think are interesting. And number 7 on our list is investment banks. And Don, I'd like you to talk a little bit about the investment bank sector as a place for investments and a place to make money in 2014.
Right. Well, 2013 has been described as the best year for initial public offerings since 2000. And investment banks make good profits in good IPO years. We think that the 2013 performance is not a one-year phenomenon, but it's more of a multi-year, stronger IPO market. And the shock is that actually Washington got one right with the 2012 Jobs Act actually improved the process for going public, particularly for small emerging growth companies. And executives are citing this as one reason why the market's improving. So certain investment banks that participate in this sector, we feel positive about.
Great. Kevin, one of the other ones I want to talk about, I think this is going to create some controversy between you and John, is precious metals. I mean, we saw gold get hammered in 2013. I know that, you take a pretty interesting stance on where precious metals lie for 14, and I'd like to get your take and then Don's take on where precious metals are going to be.
Well, I think it's interesting. Again, it goes back to sort of secular trends, longer-term trends, and particularly asset classes tend to have a lot less volatility in terms of their trends and than stock prices do, because there's a lot of things that can affect individual companies, but typically, asset classes are driven by, more defined secular themes. And we were very early in terms of finding the secular trend in gold. We started talking about gold in 2002 as possibly in a new secular bull market. Similar to the theme of interest rates being in a long-term decline and eventually sort of the theory every dog has its day. Well, gold for 10 or 12, 13 years, you would mention it, and there was disdain in the voice, of investors. And then, of course, it started this significant uptrend, and then people started buying it for a defensive play, and it became a hedge against, Armageddon, if you will, financial Armageddon. But then what happened was, as you got towards the peak, and we did a number of posts in terms of on our corporate blog, Fusion Market site, talking about basically that gold had been in the 7-year bull market, and that it was breaking sort of key support levels, and it started getting to the point where everybody and their brother wanted to buy gold. The old adage, when the pool cleaner starts giving you tips on the stock market, it's time to get out. And basically everybody was in gold. And at that point, sort of the theory is when everybody that wants to buy has bought, there's really no place left for that asset usually to go but down, because there's nobody left to buy it. So then once any selling sort of hits the market, and there's a lot of fundamental and geopolitical factors that drove the price down, but we made some very prescient calls in terms of, getting out of gold, and it had that, enormous correction. But I think when you have a 7-year or, 8-year bull market in an asset class, and then you have a correction as significant as gold has had, you don't all of a sudden just go back to like a brand new bull market. So I think if anything, I would look at gold as more of a trading vehicle. There'll be some rallies in gold, there'll be some sell-offs in gold, but I don't think you'll see a definitive uptrend, if you will. In fact, maybe if anything, there'll still be a little more slippage to the downside because that 8-year bull market has ended in gold. So I think it's more something that's going to be range-bound for a while.
Interesting. Don, I think you have a slightly different stance, if I'm correct.
Well, perhaps until we see inflation, it would seem tough to get real excited about gold. And the other thing about the printing money for the deficit is the deficit falls, and it's so far, recently it's fallen faster than we thought. That's certainly not a positive. But the bottom line for me is, which is different, is I'm more of a student of the Warren Buffett thinking on gold when he says gold you go down into the ground and spend a lot of money to dig it up and then melt it down and dig another hole and bury it and pay people to guard it. In other words, it doesn't produce income, so it's tough for me to analyze. So I don't participate in the precious metals market, so I'm kind of recusing myself from an opinion here.
And Peter, I think it's interesting when we talk about that crowd psychology mentality. There's this sort of frenzy for gold towards the peak. I did this interesting search, and again, this was something that we put in some research papers at the time. But interestingly enough, if you look at google.com/search or trends, I believe it's Google/trends, you can see the search trends on gold. And for like 10 years, the number of people that were searching gold or GLD, the popular ETF to play gold, was really, non-existent. And almost to the day, the spike in the interest in gold in terms of people searching for gold, almost as if a frenzy that everybody wanted to plow in, was right at the top. So I think that idea, and now, we do these webinars and strategy sessions from time to time, as you know, for the software product Fusion IQ and things like that. And, we would always have calls every month. What do you think of gold? Gold and Apple. What do you think of gold? What do you think of Apple? What do you think of gold? Every 2 weeks when we'd have these calls. And then all of a sudden when Apple broke, when gold broke, and people finally got hurt in those investments and then maybe sold them off, nobody asks about gold anymore. Nobody asks about Apple. So I think it's kind of interesting, and again, aligns with that point. When everybody wants to be in something, it's usually probably not a great idea to be in it with them.
So, do you expect, obviously with flat interest rates and maybe a small growth, in the S&P 500 for 2014, do you expect any action in gold whatsoever, or is it kind of muddle along?
Well, look, I think muddle is probably a good word. You had a 38% correction from the 2011 peak to the recent lows, which is fairly a sizable enough drop that even, I always use this adage, if you took a Super Bowl from, and you went to the top of the Empire State Building, and it falls precipitously, ultimately when it finds its bottom, you do get a good reaction bounce, and then of course it loses its momentum. So I think at this juncture you could certainly, see, maybe some bounce here in gold if you're a trader. It all depends on your investment philosophy and your time horizon. But, if you're somebody that thinks, hey, after a 38% correction and, on the short to intermediate term, I could buy gold here, under 120 and sell it at 140, 145. That's certainly plausible, but I don't think I'd be buying gold here with the expectation that it's going to be a long-term hold. I think muddling is a good word for that.
Don, what about you? Muddling along, is that a good term for gold this year?
Mine is not a participant.
So stay away. That's it.
I agree with Kevin. It's probably more of a trading situation than investing for the individual investor.
All right, well, good. Well, I think that's a great place for us to take a break. We're going to come back and talk a little bit about some of the comments you made, Kevin. I think our listeners may want to hear a little bit more about Apple, and I'd like to comment on that in just a minute. And then one other sector that we didn't mention in our top 10. But in the meantime, we're still going to take a short break. You're listening to In Black and Whites. I'm your host, Peter Whites. We'll be back shortly.
Voice America Business Network, the bottom line in business.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Whites and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandwhites.com. Whites is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. In Black and Whites, we win by not losing.
Stephen Douglas Associates, delivering talent, impacting results. Now celebrating 30 years of bringing top talent to some of the nation's most recognizable companies and private equity firms, whether they need highly qualified executives permanently or on a project basis. Recognized by Inc. magazine as one of the fastest growing companies in America in 2012 and 2013. To learn more, visit us at www.stephendouglas.com.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Whites. To reach Peter Whites or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandwhites.com. Whites is spelled W-E-I-T-Z. Email Peter at inblackandwhites.com. Now, back to this week's program.
Thanks. Welcome back to the show, In Black and Whites. I'm your host, Peter Whites. I got to tell you that's a catchy little number that comes in and out of the commercials. I really like it. But in the meantime, we're here with Kevin Lane and Don Burgess. We're talking about the top 10 investment themes for 2014. And we got one left. We touched on it earlier, but I want to talk about it more in depth because I think it's a pretty interesting sector for 14. But before we do that, Kevin, before we went to break, you made mention of people's love of Apple. And I'd like to get your quick opinion on what you think is going to happen to the stock price of Apple in 2014.
Sure. You interrupted me. I was actually whitesing during the commercial break, but
I appreciate that.
Well, I'm trying to help get you viral. So Apple's another interesting case, very similar to gold. Not in terms of, obviously they're two separate asset classes, but in terms of investor psychology, for a while, you couldn't mention another phone unless it was an iPhone. And if you look at Apple's precipitous run from like 2009 to the peak in 2012, every quarter, they were just beating earnings estimates by 10, 20%. And in the same quarter that year versus the previous year, they were beating, in some cases, estimates by 40%, 80%, 70%. So there was this incredible growth that Apple experienced. And then all of a sudden, somewhere around 2011, 2012, we started seeing this data come out that, Nokia phone sales are up, Samsung phone sales are up. And all of a sudden there was this, the phone didn't change. It was just that other people's technologies caught up to Apple. And all of a sudden, for the first time in a long time, it became like, that Samsung phone's kind of cool. And for a while, it was almost heresy to mention to somebody a smartphone. The word smartphone and the iPhone were synonymous, and all of a sudden, competitors started introducing new apps and new applications, replicating some of Apple's technology, what have you, and Samsung started making inroads, and there was all this data showing they were catching up. And if you look at earnings relative to expectations recently, Apple actually in the last 6 quarters has missed earnings expectations twice. They've beat analyst estimates by only 2%, 1%, 2%, 4%, 3%. So what became these huge outside surprises? So if an analyst said they were going to earn, $1, they were coming in 30% higher. They were coming in 80% higher than the same quarter a year ago. And all of a sudden that earnings momentum dissipated, and with it went the stock price. At this point you could get into a lot of arguments about valuation and how much cash they hold on the book. I think Apple is kind of, in a similar place in gold in terms of, I think it's going to be muddling, and I think it's going to be more of a trading vehicle. They're really a byproduct of their own success. They kept raising the bar so high, and then all of a sudden they couldn't get over the bar. And so, at this juncture, I think Apple's going to be range bound for a while. Again, after it, broke that, 5 or 6 year trend of being up, I think you're going to see Apple sort of trade in a range for a while.
I appreciate that. Don, our last theme for the year is energy. And energy got hammered in 2013. And it's an interesting I kind of think of it as confusing because every time I go to fill up my gas tank, I'm like, my God, gas prices are so high. But yet then I look at energy as a sector and I see that it's just getting pounded in the markets. And so give me your insight as to what you think energy is going to do in 2013, and more importantly, why, and why is there such a disparity between what I pay for gas and what happens in that sector?
Well, we're focused on the energy services sector, which is, and in that sector, these are companies that provide equipment and services for drilling rigs, whether they be on land or at sea. And this sector was really hurt by the BP Gulf spill, which killed the Gulf, and then the natural gas surplus from the warm winter of 2012, which hit the land rigs in natural gas. In fact, many of those natural gas rigs were capped. Well, after this winter, they're going to be starting some of those up. But actually, we've seen the natural gas rig count start to go positive for the first time in some time. And the valuations, the prices of these stocks are still reflective of the problems. There hasn't really been a recovery in our business. And many people say the fracking recovery is still a couple of quarters away. So, but it is an area where you can skate to where the puck is going to be and probably have some profits going forward.
And how do you think that'll, sort of this, and Kevin, please jump in on this. I mean, we've
Sure.
talked a lot about fracking and natural gas. I mean, ultimately, what's the long-term outlook of those sectors and how, I mean, we know the servicers will, in the short run, make their profits because they're doing the work. But ultimately, I mean, are we going to have more of a reliance on natural gas?
Well, being a former hockey player, I love Don's analogy of skating to where the puck's going to be. So I have to give him a hat tip there. I think it's interesting, and there's all kinds of, the discoveries in the Bakken, the Permian Basin, Eagle Ford shales. This is the first time in decades, that oil production is up. And at the same time, because of energy efficiencies and different things, our actual use of energy is down. So you're getting a double effect. We're finding more domestic energy, and at the same time, because of fuel efficiencies and different things, our actual consumption is up. And I think that gap is going to continue to widen, where we produce more energy domestically. That'll drive the price down because there's estimates of how much oil and different and natural gas in the shales that are out there. And I think, interestingly enough, and we've talked about this sort of internally, that this could be one of the drivers of a new secular bull market for the stock market, America, the economy, that 2/3 of all GDP growth is based on consumer spending. And right now, people like you said, Peter, are still getting hurt at the pump. But if over time these domestic energy finds start to lower prices at the pump, and also with the energy efficient vehicles and everything else, that's a major boost to GDP and spending power for the consumer. So I think that's a powerful combination that's being underestimated, in the marketplace right now.
I appreciate that. So let me just summarize for the listeners out there. Today, we had Kevin Lane, managing partner of Fusion Analytics, Don Burgess, senior vice president and a researcher with Fusion Analytics, on the line. We discussed the top 10 investment themes for 2014. Let me just recap those for you real briefly. Number one, we feel there's going to be economic growth here in the U.S., but the GDP is going to be in the low threes. We think fixed income, continuing to watch interest rates may be a place to find some opportunity. We like U.S. large dividend-producing domestic stocks. We feel very bullish on Europe. We had some basically no interest in the precious metals and watch that sector carefully. We like municipal bonds. We love energy. We like commercial construction, the investment banks, and we like big pharma and healthcare. I'd like to thank my guests, Kevin Lane and Don Burgess, for being guests on my first voyage here on the Voice America Business Network. And I really appreciate your insight, gentlemen. And thank you again for coming on the show. Next week on the show, I've got a very interesting guest. For those that have followed a story that broke nationally last June, Chip Starnes was held hostage in his factory in China by Chinese workers when he went over to close the factory. He's going to be on the show. He's going to talk about his experience of being held hostage and the new phenomenon that's going on, particularly in light of the Goodyear story in France called boss napping. So you want to make sure you tune into that. In the meantime, you can feel free to still email questions. Kevin will get back to those as soon as he can. Don will be happy to answer them. You can reach me at peter@inblackandwhites.com. You can follow the blog at inblackandwhites.com. My Twitter handle is @PeterWhites. My LinkedIn account is peter.whites. And I appreciate you all listening to the show. We've had a really interesting conversation today. I think we're going to have a great conversation next week. It's been a tremendous show, a tremendous week, and I appreciate you all being online. Again, my name's Peter Whites. The show is In Black and Whites. It's all about business. It's all about smart business. It's all about smarter investing. And with that, I thank you very much.
Thank you again for tuning in to In Black and Whites. Please join your host, Peter Whites, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.